Good afternoon. This is Betty Meredith, President of the Retirement Resource Center, a retirement education and training company for professionals, clients, and consumers. And I'm happy to be your host today for this webinar on our health savings accounts, better than a 50% employer match on a 401k.
With Greg Geisler as our presenter.
Health savings accounts are quasi-retirement accounts because of the ability to save tax at contribution, not be taxed on the earnings if the contributions are invested, and withdraw funds tax-free if the funds are used to pay for qualified medical expenses from either current or prior years. The tax treatment of HSAs is so favorable that a contribution to it can end up making an individual wealthier than a contribution to a qualified employer-sponsored retirement account, including the employer's matching contribution. This fact raises the issue of whether there is a tax-efficient order for investing, meaning for HSAs, Roth and tax-deferred retirement accounts, and non-qualified accounts, and also adding in paying down debts. This presentation presents the tax-efficient order that will maximize wealth.
Greg Geisler
received his PhD from the University of North Carolina, Chapel Hill, is a clinical professor of tax accounting at Indiana University, Bloomington. He teaches a course called Income Tax and Individual Financial Planning. Greg has published articles at the intersection of income tax and financial planning. Specifically, in the last 10 years, he has published 6 articles in the Journal of Financial Service Professionals and 7 articles in the Journal of Financial Planning, including one that is the basis of this presentation that received the journal's 2017 Montgomery Warshaw Award for Most Outstanding Article contributing to the betterment of the financial planning profession. At Greg's previous university, he was awarded the only 2017 Chancellor's Teaching Excellence Award, and he has been quoted in the Wall Street Journal many times, as well as in other financial press and on newscasts. So Greg, thanks so much for being here today. I'm really looking forward to this presentation, and we'll now turn it over to you.
Thanks, Betty. Greatly appreciate it. Very happy to be here. So if you look at the fine print, the article within this article, the tax efficient order to invest and pay down debts. In other words, how to maximize wealth while you're working. In other words, tax efficient accumulation of wealth. There's a lot of articles on tax efficient decumulation once you retire, but there is a very clear tax efficient order for accumulating wealth. And that's what I'm going to go over today. Is it possible an employee's health savings account contribution can increase their wealth more than an employer's 401k match? Yes, it is. It's quite possible, and it happens a lot, whether people realize it or not. And I'll show you how common it is, and I'll prove it to you mathematically, visually, computationally, and I've even got a fourth way in there to prove the point. So after we do that, then we'll get on to the tax efficient order to invest and pay down debts to maximize wealth. And after this presentation, you'll be able to rank order all the different investment vehicles under the federal income tax law. So that includes Roth retirement accounts, tax deferred retirement accounts, often called traditional retirement accounts, and health savings accounts, as well as we'll talk about 529 higher education savings accounts. Little background on health savings accounts. First, you can only contribute to one if you've got high deductible health insurance, which many employers, that's either the only option or it's one of a couple of options that they offer. So you got to have high deductible health insurance. So there's over 30 million health savings accounts currently in the US. And the number of accounts has been growing by approximately 10% per year over the last few years. So more and more people have a health savings account every year. Now, typically people put in approximately enough to cover their qualified medical expenses for the year. So you see over 2/3 of contributions are withdrawn in the same year. But unlike a flexible spending account for health expenditures, where you have to use it or lose it, the health savings account it's yours. It's yours as long as you're alive. And it's like exactly like Betty said, a quasi retirement account. You can invest. So there's 90 billion in health savings accounts as of the most recent period that a company called Devenir keeps track of this. Notice how much higher that is. It's about 70 billion higher than there was, oh, what is that, about 7-8 years ago? And only about 1/3 of the 90 billion is invested, whereas 60 billion is basically sitting in cash. And I've got one more statistic not on the screen. Of the 30 billion that's invested, about 20 billion is in bonds, and only about 10 billion is in stocks. So that's an opportunity that's being missed, is put money in these health savings accounts for the long, and to the extent you don't withdraw it in the same year, invest it for the long term if you don't need the money for a good while. That's what I do. I've had a health savings account since 2015. In other words, I've had high deductible health insurance through my employer every year since 2015. I put the maximum into my health savings account every year, and it's grown to, and I invest it in, pretty much U.S. stock market, just an index fund. I don't pay any attention to it. I looked at it recently. I've got $60,000 in there, and I've saved, since I started my health savings account back in the beginning of 2015, I've saved $35,000, yes, that's correct, $35,000 worth of qualified medical expense receipts. So in other words, anytime I want to, going forward, I can take out up to $35,000 tax-free. Well, why am I waiting? Well, because I'm still in my peak earnings years. I'm still working full time. But when I'm retired, and let's say I get to the top of a tax bracket and I don't want to jump to a much higher tax bracket, that'll be a great time for me to take money out of my health savings account tax-free and just put some of those receipts that I've accumulated into that year's tax folder. So that's a big advantage of a health savings account, is the ability for it to be a quasi-retirement account.